gold has broken out, and it doesn't mean you can't retrace to the scene of the crime. This is very common where it comes back in here before it makes its next move up. But either way, it's going higher. So again, if you want to split hairs and say, all right, I could get it $500 cheaper, and I guess $500 cheaper potentially is pretty good. But either way, it's going to 13,000. Silver into resistance right here, guys. Again, I'm expecting a retrace back to this line here. So probably back to about 58, maybe lower depending on how long it takes. And then the next step is to watch for a breakout above this trend line here, which sits around 66.5 to 67. We get that breakout, off to the races it goes.
Precious metals are experiencing significant structural shifts as critical multi-month consolidation patterns resolve to the upside. While brief retracements back to prior breakout zones are completely normal market behavior, long-term technical configurations point toward powerful upward continuation. Gareth Soloway, a chief market strategist and veteran technical analyst, emphasizes that objective chart interpretation consistently reveals high-probability macro trajectories long before traditional media narratives take notice. Proprietary valuation models and liquidity calculators indicate that gold is charting a path toward a long-term target of $13,000 following its decisive wedge breakout. In the silver market, an expected corrective retrace toward the $58 benchmark will set the stage for an explosive breakout above the $66.50 to $67 resistance boundary, off to the races. Across broader equities, prevailing bullish momentum projects a continued melt-up into year-end, targeting the 8,100 to 8,200 zone on the S&P 500. Tracking these specific price milestones provides clear execution levels during major market cycles. Now, we present the clips from Gareth Soloway's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Let's flip over to gold and see what gold is up to right now. If we take a look at gold, gold is up slightly. We did get that wedge breakout. Remember how long ago I put this wedge on my chart, and finally we broke out? Now, I'm still not convinced we're not going to come back down here, but ultimately gold's going up, right? I mean, whether we come back and we retrace here, whether we just go sideways and then break up, or if we have a bigger retrace down to this area, the point is gold has broken out. And it doesn't mean you can't retrace to the scene of the crime. This is very common where it comes back in here before it makes its next move up. But either way, it's going higher. So again, if you want to split hairs and say, all right, I could get it $500 cheaper, and I guess $500 cheaper potentially is pretty good. But either way, it's going to 13,000. At least that's what my charts and my research and my calculator, which is available. My gold calculator is available on Verified Investing on the dashboard. If you just have a free account and log in, and you can do this on the app too. You can download the Verified Investing app and you can get access to it. But literally you'll see the base case where the current numbers are that I'm using, where my analysis shows that we're going, and then you can actually slide the calculator to what you think: M2 money supply expansion, debt here, all of these other factors. Speaking of which, the US hit 40 trillion in debt just in the last few days. Crazy stuff, guys. All right, so that's your silver update real quick. Let's go to gold here. We look at gold, so that was your gold update here. Let's look at silver. Silver into resistance right here, guys. Again, I'm expecting a retrace back to this line here, so probably back to about 58, maybe lower depending on how long it takes. And then the next step is to watch for a breakout above this trend line here, which sits around 66.5 to 67. We get that breakout, off to the races it goes. Now, Bitcoin, got to talk about Bitcoin, guys. I know a lot of people don't like Bitcoin. A lot of people love Bitcoin. I talk about it because it's a chart. And honestly, when you become agnostic in terms of not caring what you're trading, you're just trading charts, the freedom you feel is incredible. All right. When you are emotionally tied to something, you make bad decisions. Just the nature of the beast. We get emotional, we buy at highs, we panic at lows, right? The beauty of it is it is a chart. A chart there's a million charts out there, treat them all the same. Whatever the asset is, doesn't matter. All right, so here we have a trend line, descending trend line. It broke out. Notice how it hasn't gone back below. That means it's still net bullish. And what I love about today's price action, it's creeping up here. which is good to see. It tells me accumulation is going on. And I've been a big believer that since this breakout, this selling on the negative news on the Clarity Act, there was supposed to be another little meeting on the Clarity Act that got postponed again. And so that's why it sold off again today. We saw, obviously, Congress went on recess without passing the Clarity Act. All these things are headlines that are panicking retail. But I'm telling you, the chart is the arbiter of truth, at least high probability. And it's telling me that it is still open to a big move up here. So I'm just throwing that out there, that the chart is the chart. This could be a chart of Microsoft, could be a chart of Apple, could be a chart of gold. I don't care. It is what it is. And as long as we hold above this white trend line, probability favors the upside. So let's keep an eye on this, see where it goes here.
Mastering modern financial markets requires maintaining a strictly agnostic approach toward every asset on your screen. Becoming emotionally attached to specific tickers clouds judgment, frequently causing individuals to buy at market tops and panic sell during routine corrective pullbacks. A chart is simply a visual representation of human psychology and order flow, meaning every setup deserves identical, dispassionate technical scrutiny. Recent price behavior illustrates how sensational headlines, regulatory postponements, and political recess announcements trigger irrational retail panic. Yet, steady price compression above established descending trendline signals sustained accumulation rather than genuine distribution. Focusing entirely on structural trendlines strips away outside noise, allowing disciplined market participants to navigate market volatility with unmatched clarity and consistency. Now, let's get back to the interview.
We're going to start with the S&P 500, which right now on a Friday afternoon is fractionally lower. But again, to me, this is a very crystal clear up move. You have this move to the upside, consolidation. We should see continued melt up in the markets. Now, it doesn't mean we're not going to have a down day here and there, but this pattern based on technical analysis is still bullish. And I still have a near-term target before year end, maybe around the elections or just before. I still have that kind of $8,100, $8,200 price target on the S&P. And by the way, just to give you a sense, where is that? Let's take a look. 8,100 would be about 4%. And if we go to about 8,200, it'd be about 5% and change. So 4 to 5% upside. Once we get there, then the M2 money supply chart with the S&P, US M2, this is what is concerning me right here, right? So if we look at this, we go to our weekly chart, and that move on the S&P in terms of M2 money supply would take us right up here, which would put us in line with a parallel channel going back to 1982 with the dot-com high. So we would max out at the dot-com high. And remember, this is the chart, just so I can explain this properly. This is the S&P in terms of M2. So it's taking into account the amount of money supply in the system. And that's important because you could argue that the more money in the system, the higher the market should go. And that's what we're seeing here. We're seeing the S&P in relation to that. So it kind of clears out that whole nonsense of, well, there's more money now, so that's, the S&P. Well, this takes that into account, and that puts that parallel up at that level, which would map out to about 81, 8,200 on the S&P. Very cool chart, by the way. Really kind of scary chart, frankly, as well. All right, so let's get into a few other things here. So if we go back to just the S&P 500 chart, we go back to the daily chart. Let's draw our trend lines on this chart real quick. We're going to use our parallel. We go back to our COVID low. That's a major low. We drag this trend line up here. And what I want to show you here, which is so cool, is if we bring that parallel up to the high of the bull market right here, okay, look at what happens. We basically get this high and then these lows. And this is why once we got above here, we talked about, okay, this is the market breakout. And then look at how it tested and held, came up, almost tested, held again, tested again, and then up we go. And then we're getting this little bit of consolidation in the charts right here, right? This little sideways action, which should lead us to a little bit of upside. Now, what would change my thesis? Because remember, any good trader knows when to say my thesis has failed. So when would I know and be able to say, based on probability, that we're not going up to that next level? And the answer is pretty simple. Just watch the parallel. So we know that this has already been established here as major support. If the S&P all of a sudden goes like this and then starts coming down, coming down, coming down, and breaks below this line, so basically if we were to get below 7350, 7400, depending on where this slight ascending trend line is of the parallel, then it's off the table. It would be a failed breakout. And you know what happens when you fail a breakout? You usually have massive moves to the downside. I would guess we come here. I mean, there'll be a stop at these former highs here, but I think we would have a much bigger corrective move because that's generally what happens when chart setups fail. Okay, so again, short-term bullish to about 81, 8200. Once we do that, we max out at our .com to money supply, M2 money supply high of the parallel. That would dictate that you would possibly get as big a collapse as we got during the .com era. Not to say it's going to happen overnight, because it certainly didn't with the .com, but I mean, over the course of a year or two, I think you have that type of drawdown potential, which is kind of scary.
Evaluating broader equity strength through the lens of macroeconomic liquidity provides a crucial perspective on long-term sustainability. Examining benchmark indices alongside expanding M2 money supply accounts for structural currency debasement, clarifying whether equity gains reflect genuine corporate expansion or simple monetary inflation. With national debt balances recently surpassing the staggering $40 trillion threshold, understanding these liquidity channels becomes vital for long-term capital preservation. Historical analysis reveals that current equity trajectories align directly with a multi-decade parallel channel dating back to 1982. While upward momentum remains intact along ascending support baselines, multi-decade upper bounds match the extreme valuation parameters recorded during the peak of the .com era. Every robust technical thesis requires a definitive invalidation boundary. Should price action violate key lower channel support, the bullish framework is formally voided, triggering a failed breakout dynamic. Failed technical patterns historically generate severe downward velocity and prolonged multi-year corrective drawdowns. Tracking these overarching parallel channels ensures portfolios stay protected against sudden macro reversals. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.